Today we're going to cover common dump patterns you can use to profit. So these are move starts going, what do? You want to be on the move, but you don't want to chase. That's a fine balance in trading. You never want to chase, but you need to know what is chasing, when is it chasing, and when are good entries. I usually like to risk about 10 to 15 points to make 50 to 60. So I'm looking for minimum 4 to 1 potential on my trades. So I want to see some movement in the stock as it continues to go and tell me that it's going my direction. But when is too far, and then when things start to happen in the morning and it starts to move down, I'll tell you a few tips that I use in order to identify when the move is coming and then when to get confirmation and when to get in, and then you can ride it out to your next profit target. So we're going to cover some downside setups today only. We're going to talk about tips for strong psychology. Remember, the downside setups are very similar to setups to the long side. The only difference is downside is stronger. I'm a downside trader. I'm a short bias trader. When things go down, it makes me more excited to trade simply because fear is stronger than greed. People get greedy and things go up. But when they go down and people get scared and there's lots of selling going on and the algo is pushing it down, it goes down fiercely. And if you can just hold an extra few minutes, an extra candle or two, an extra 15 minutes, you can really get paid well, especially on these dump days. There have been many dump days. We're at all-time highs. So once this continues to curl down, there will be more potential on these. So those of you studying this material, those of you watching it on the recording, study this well, watch it again, and then go back to some charts and review them and see how you can apply this to your strategy to continue to make money on the downside. But first, highlight of the week. We got to give a shout out to One Alpha. He joined the live trading program, I think in December, if I'm not mistaken, November last year, and been studying a lot. He's got his funded accounts. He's passed 3. I think he passed his 3rd one about 3-4 weeks ago. And this was his biggest trading day already on a funded account with real money. So, and then he actually texted me this morning and he had another one, which was about the same size overnight. And the market hasn't even opened today yet. So shout out to One Alpha. You've been putting in a lot of work, and I'm proud to see this success come to you. Keep the consistency going. Don't get complacent, because when you have some big days, then usually people tend to think that it's easy again and then oversize or take bigger losses the next few days. So keep up the positive trend, keep up getting in good trades, and keep your risks small always. You should be proud of yourself, and we all are proud of you as well. J Beta, big trade on QQQ yesterday here, filled at 350 all the way down to 450. Stop loss was here. I think his fill was a little bit lower, like 4. You can be at about $1.30 on each of these contracts, and play 10 contracts. So it's a nice like $1,400 trade, and this is like following the trend. Took a short there and took an exit here and just followed during that macro time frame. This is the trade that we were in at the same time. So I'll explain how that works also. But proud of you, buddy. Good work. Okay, now it's chart time. Let's move over to the charts. The first thing I want to explain whenever we're looking at downside moves is when they come in very fiercely. So this is the daily on NQ. For the sake of the analysis and keep things very specific, we'll keep it on NQ, but these patterns apply to every single ticker time frame that you do. So we'll start on the daily and you'll start to see some things. So when things are bullish like this is a very bullish sign, very strong. What you want to look at are several different indications that if this were to go down, where is there liquidity? There's liquidity here, here, and here. And I'm going to talk about this pattern in a moment, and we'll go into the specific entries and exits. Once you start to see this is still a bullish pattern. Price came down and held and started to push up. This is very close to all-time highs, so you expect it to move up towards all-time highs. And that's the premise. But remember, this It's the last order block. And we always use the order blocks to the midlines to see what's happening around that space. Price came back up into this first fair value gap. Price came up again, and now here into the order block. And that's when it started to turn right back down. Now, something very specific. This is a common pattern that happens often right before a dump. The previous high, usually price goes up above this previous high, and then will wick down for a strong move to the downside. If you look at all these daily candles, very rarely, this is the only exception, will you see flat tops. So any of these red candles, look at this line. The line went all the way up, the wick above went above the previous one, and then created the downside move. Look at this wick. Wick created a move up above the last high, and then went down. Even here, the start of the move, the wick went above the last candle and then went back down. Here, aggressively high and then came back down. So just realize when you go look at these candle time frames, only really on the gap downs and the continuations here. Even here it has a small gap, but usually wick on top and then it moves back down. Even here is an example. Wick goes up above previous day high and then starts to move down. So with the anticipation that you can see a move down, you should be looking at the chart on the daily, then looking at it on the 4-hour, and then monitoring what is happening as this is building. I like to build these on the 4-hour and then look at the 4-hour candles from 10 o'clock and from 2 o'clock. Big Ray puts in the comment, power of 3. Exactly, power of 3. I talk about this pattern often. People have titled it AMD, accumulation, manipulation, and distribution to the downside. Why does this happen? Because the algorithm needs liquidity. So if it wants to go down, it knows there's a bunch of stop orders here. And it knows it's a bunch of stop orders here. So going to go capture all these, get the liquidity. Remember, all the market makers who are facilitating these trades are getting their commissions. So they need trading to happen. They need executions to happen. So it goes out, takes liquidity there, and then moves down and captures both sides. Coach Shah teaches the double purge pattern also on both sides. Sometimes there's a double purge pattern before that happens. So this is the similar idea. If you're going to be looking for downside moves, this is usually how they start. So if you look at this one, a wick above, took out previous high, and then went down. And then what happened here? Wick above, and then started the downtrend. Small wick above, started the downtrend. Wick above, closed, kind of even, and then wicked up, and then started the downtrend. So look out for these wicks that go up on the daily, but also on the shorter time frame. Number 2, look at the 4-hour trend. It's really important, especially on NQ. 4-hour trend, can there be reversals? Always, but the 4-hour trend will give you information about market structure on the larger time frame. So this is the last leg that took price to the high. So as soon as this is broken down here, this is the official market structure shift, and this is downtrending. So when things are downtrending, before you see a curl pattern like this, downtrending means downtrending. I like to get my direction from the 4-hour and then use the 15-minute as well. But the 4-hour always tells you what the overall story is. It won't be the first to tell you when things are turning. That's why I use the 5-minute and the 15-minute in the analysis for things that are starting to curl like this and move back up. But if you're looking at the trend is down. The trend has been down since February 21st. The last whole week has been down, 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 down. So here's a test. Go back to your trade log for the last 7 days. And after this candle, big red candle, most of your trades should be downside trends. And if the trades are to the downside, then you're following the trend. If you're at 50-50, or maybe you have more longs, maybe you're trying to catch reversals a little bit too often. But this is a signal to use when you're trying to catch something to the downside. When they start moving down, look at this 4-hour. Look at the 4-hour. It will start to move, and then there'll be continuation to the downside. Once you see these strong candles here on the 4-hour, they'll continue to move down. Strong 4-hour candle, continuing to move down. Strong 4-hour candle, continuation back down. The reverse is also true. Strong green 4-hour candle, price tends to continue to go up. So keep an eye on this and use it into your analysis. Don't overemphasize the trend direction, but just be aware. It doesn't mean you can't take a long if the 4 hours on the downside. Just know you're going against the trend and be aware. And then if you get stopped out a few times on a long and then you look at the 4 hour and it's short, it's a big red candle downwards, then you at least know why. If I can eliminate 2-3 stops a week from your trading, that will be very profitable. So it's not only about how can I hold longer, how can I get in from a nice green trade, but how can you avoid taking a trade that stops you out? Something that can tell you not to take that trade will help you become better. Number 3, this is one of my favorite tips. So same premise as the daily, I was describing that price goes up, takes out liquidity to one side, and it's not that it's just trying to capture, it's the fact. It's not just trying to capture liquidity and stop losses, get people trapped and move the other way. It's not that it's trying to do that and then go the other way. It's the fact that it does that is what causes it to go the other way. That's where the momentum happens. It's like a rocket, right? You stay in a certain position and you coil the gas, you get ready, and then as soon as you move, you slingshot it the other way, like a slingshot. Slingshot, you pull back and then you reverse the other way. In a very similar way, that's what price does. Takes out liquidity one side and then slingshots the other side. This was yesterday morning. Full disclosure, I missed this move and I was thinking about it, and when it was gone, and I looked at it afterwards and I said, wow, that was very clean. And so I'm studying this move and it happened several times this week and it'll give you this pattern. This is the morning, 9:15. This came down, came back, rejected here, relatively equal highs, 1, 2, 3 highs roughly around the same line. What does price do? Starts to move up. This is still before 9:30. This is 9:30. Yeah, so 9:32 started to open, moved up, takes out this liquidity, so it goes up above. Still looks bullish right now, and then huge engulfing bearish candle. If you guys watch volume might have been on there as very high, but either way, volume should be high in the first few minutes. Yeah, volume was bigger than the last one also, but this is the high. 1, 2, 3, relatively equal high here. Price came up, went above, and then immediately pushed down. What is immediately pushed down? It means it doesn't give you a chance to exit if you happen to enter here. You don't get the little bit of movement thinking it's just aggressive. That's what happens on times when price starts to go down. So this is the aggressive entry. I've done a few of these, but they are hard. They are hard, they're risky. It's very difficult to get your exact timing for a stop loss. I would have placed my stop probably 74 entry and probably 7-8 points. It would have been very close to a stop loss because it's aggressive at this time. But more importantly than deciding to enter right at this line, you got to see what is happening. Price comes up and then quickly reverses down. And that's what starts the movement down. Now, if you're waiting for this fair value gap or this fair value gap or this fair value gap, there was no chance. And this is how the aggressive movements happen. So how do you get in on a move like this? Okay. There's 2 ways I'm going to show you, but you have to practice them and they're not easy. The first way is you're watching the fair value gaps that open up. This example is going to be a little bit harder because it's market open, but a little bit later in the day, the candles are not so big. The first strategy, if it's aggressive, is you take the inverse fair value gap and you wait for the closure below it. This is when it completely flipped the fair value gap. So this is your last fair value gap, and then you have an immediate push below. So you wait for this candle to close below, and then you look for an entry here once it's below with a stop loss above this fair value gap. It shouldn't, if it's aggressively going to move down, it may have a little bit of a wick retracement here. You don't know how long, but it shouldn't go above this fair value gap. The inverse fair value gap that was bullish, it was green before price came through. So your entry would be here at the end of the candle with a stop loss here. Now you have to monitor, because if this was 365 with an entry at 347. It's almost a 20-point stop. Are you comfortable with that? I also like to wait just a little bit. If this starts to come up a little bit, I like a pullback entry before continuing. But be aware that this is a tough entry, especially when it's moving so fast in the first 10, 15 minutes of the day. But that's how to think about it. Because if price is going to do what you want it to do, if you want it to be in the short, you want it to go and not come back at all. So inverse fair value gap, watch for it to go through. Once it closes below, it's the confirmation. Confirm that your stop loss is above here, and that's how you can enter on the short side. Now, where is your target? Just here. This is the first reasonable target. But if you wait for an aggressive push, then you go back and you look at some of the other values of where it can go. You should have charted these before anyway. These should be already on your screen, right? These lines of the lows and the ones that we cover in the morning, you should be charting every morning. Technique number 2 is for the last move up, I like to look at the last red candle before the move up and have the same premise for this. This is the order block, pushes straight up. When you get this confirmation breakdown through in here, I like to look for an entry in here. Once it closes below, you can use the same entry strategy as here with a stop loss at the midline. These candles are tougher to play because they're just aggressive, aggressive, aggressive down. But more often than not, if I were to take this entry, I actually wouldn't have entered here. I would have waited for price to close underneath and then a small pullback into this area for a short. What I don't want you to do is overemphasize that I want to get in on this. So tell me an entry strategy that will get me in on this aggressive, because you may have made money on this aggressive move with a type of chasing entry, but on the next 4 out of 5 trades that you take, the pullbacks will be there and they might stop you out. These are the 2 entry strategies you use. Go back and apply them and see when they work and don't work. But don't try to get too aggressive entries that are almost in the chase category, because on other days when it doesn't go down so aggressively, you'll have much cleaner entries and you want really clean entries. The third entry technique, and this is how you can limit risk. I actually got stopped out and then I took it again. Downside move, very strong movement down and it starts to consolidate. So I wanted to see how price reacts in here. Price dropped, came back up. This is the first order block, and I want to see how sensitive is it to this block. Price came back down and then started to come back slowly up here, and then slow down here, stay above, and then on this move down, I took a short. This started to come down and I shorted it here. And I think I got in around 40, around here, maybe 47. 45. Somewhere around the bottom of this wick of the green candle, I entered in on the short of the red. And I put my stop loss just inside these, just above like 62. And so I expected this to go, maybe pull back just a little bit and then continue to go down. What did it do? I did that. I was happy with that. I was happy with that. This came back to my entry. And so I expected it to reject in here, the midline, and go down. It actually stopped me out here, and my stop loss was a little bit too close. And I look back in my trade log, I should have had my stop loss above these wicks, not below the wicks. So it was responding to this order block, came back, rejected this midline, and came down and did everything I wanted it to do. And it came back up for one more tag, still did the same thing, and continued to go down. So then I waited, and then after this candle, then I tried the short one more time. And why did I try it again? Because it gave me several signals that it's still doing the thing that I expected to do. Move down, big strong order block, green candle here, pushed down below once, came back, and wouldn't close above this line. Came back, pushed down, up, pushed down, up, pushed down. Many signals in here in the top half of this box that's showing that the price is still pushing it down. Plus, we had the big move down, continuation, and then we had that first 400-point drop in the beginning of the day. So then I took a short here once it started to move down, and this time I put my stop loss above these wicks just in case I'm wrong, and gave it a little bit more room. And then as soon as this started to drop, moved my stop loss to break even. I think I was just about here, and then got a piece of this drop. And then I think I was fully out by here, held it for a little bit longer here. And then there was still more and more and more down there. But don't let that FOMO get to you, because if it continues to go down, I still get FOMO that I should have held longer because I'm working on holding longer. Hold, James, hold, I say in here. And it's training my mind to hold longer, right? And remember, that doesn't necessarily mean it's the right thing for you to hold longer. You have to find the balance between the technique, getting in, taking a green, and getting out. Because sometimes I hold for a little bit too long and it completely reverses back to my break even. And I'm okay with that because it's giving me data and stats so that I know, should I be holding for 70-point moves? Should I be holding for 50-point moves? Is it a 90-point move? Is it depending on the day? It depends on so many factors. So I'm able to gather that data, which is helpful. But this technique helps me watch for how is price responding. The common thing is this is going down, it has to go up, right? Yes, it has to go up, but it doesn't have to go up this much. You will see green candles, but are the green candles good enough for you to get in on a long? Ideally, you want to continue with the trend. If the 4 hours downside, look for how price rejects. And if you get a trend, this is my fourth and last tip I'll give you today. If you get a big trend move down here and you feel the FOMO, wait. Because if you go back and look at charts, price needs to do a little bit of consolidation for a little while before the next trend move continues either downwards or it starts to do a fake out and then go up. The fifth tip of the morning is if you catch a move like this that's starting to go down and you're accustomed to getting out early, like I am, like when I see a dump like this, I would be taking profits here around this area very commonly, is once it starts to move your stop loss to break even, can't lose money, you're in a great position, small green or big green is all you can get. Just try holding one trade to 10 o'clock. Because very often on these dump days in the morning, it starts to dump around 9:30, or first few minutes it goes up above, and then starts to dump around 9:37, 9:38, and starts moving down. Then what you do is just wait. And I'm telling you, this is going to be one of the hardest things you've ever done in trading, to just leave your position on, move it to break even, and sit there and do nothing. Nothing. And let it pay you. Because very often these dumps, they bounce at 10 o'clock or at 10:30, plus or minus like 1 or 2 minutes. Yesterday's drop, 10 o'clock would have taken you to here. 9:30, all the way from, let's say you had an average entry around here. 370 points. That's ridiculous. That's actually bigger than any trade I've had. I haven't had a 370 point winner yet. But that's one strategy that you should try to implement. And it is going to be hard. It is way harder than you think it is. But I want one of you to be able to do that and then let me know the results when you do. But I'm not saying you blindly hold a trade with no stop loss. Be careful. I'm not saying that at all. Once you're in the trade and it's working in your direction, move your stop loss to break even so you cannot lose any money. So 100% chance you're going to be green. Then you can even, for psychology, you can even take a position off, take half off, take a third off, take 2/3 off. But leave some to 10 o'clock to see how it trains your mind and then compare the results. And then let me know how it goes. Sounds good? Several tips for catching the downside. I hope you guys can apply at least one of them to make some money because there will be more downside to come. It might be a little bit longer. We have to wait for that to happen, but there will be some. And we will make money with it.